Charlie Munger once said back in 1998 that the first 100,000 is a bitch. But in 2025, with inflation and lifestyle costs, that number is actually closer to 200,000. And hitting it, though, still unlocks the same powerful shift. Today, I'm going to break down why wealth starts compounding way faster once you cross that threshold. And it's not how you probably think. So in that quote, he is correct. After all, things really start to compound where you can see bigger numbers compounding on themselves. Again, 27 years ago, that same 100,000 is probably more like 200,000 or even 250 today. But do I still believe the idea behind it? I do. Because compounding works no matter how much money you have. The real difference is psychological. When you see those six figures in your account, it hits just a little bit different. It feels like you're finally getting somewhere. You're one digit away from $1 million. There's a lot of runway between 100,000 and 1 million where the gains can really start to appear to be adding up. And when you feel that, you start to behave differently and you might even start saving more. Now, does everything just magically change like that at 100,000? No, not necessarily, but I'll tell you what does change. Your options. Specifically, you can use strategies like covered calls that could potentially triple or quadruple your stock market returns over the next 30 or 40 years, but more on that later. Now, let me break down the rule of 72, which is something I'm sure a lot of people have heard about. So as an example, if you get 10% return, 72 divided by 10 equals 7.2 years. It'll take about 7.2 years for your money to double if you earn 10% per year. What we try to talk about here is what feels different. When you've hit that milestone, you're probably more likely to start saving some more money. When you start seeing gains of a few percentage points, that's in the thousands of dollars versus the hundreds of dollars. Einstein once said, compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. Now, guys, let's say you're 25 years old and you're starting with $15,000. This is our retirement calculator. I love our retirement calculator because it doesn't just stop at retirement. It goes all the way through until you estimate a year of death. Sounds morbid? It is. But it's really important to understand that. And the chart here on the right will really show you the effects of compound interest. I'm assuming 9.5% returns in the market, which is done between 9 and 10% a year over time. You're at 25, you're going to retire at 65, 15,000 in savings, and you're adding 8% a year, increasing by 3.5%. Now, at 35 years old, you have $207,000 in savings. Now, the great thing about our retirement calculator, it shows inflation adjusted about 150, but we're going to focus on the dollars here. So you go from 15,000 to 207,000. Guys, age 45, look what you have. Age 45, you have $723,000. 10 years later, you have over 3.5 times more money. Okay, let's go to age 55. Age 55, you have $2 million more, 2.1 million, almost 3 times more money. And 10 years after that, age 65, you're retiring and you have $5.6 million. Do you see how fast that went? All you were doing was saving $8,000 a year and increasing it with inflation. That's it. It's an incredible ability to really grow. But when you're in the weeds of it and seeing it year to year to year in the market fluctuations, it can feel like you're going nowhere. And then you wake up one day and you're like, oh, wow, look at this account. It's a lot higher. Now, I go through this chart all the time. This is my go-to. This is where stock market values go over time. Values. This is where the price goes along the way with it. Guys, prices are going to go up and down like crazy. Don't let the market and the price action of a stock tell you what the stock is worth. What we know is, for the stock market in general, as the US economy gets larger, as the world economy gets larger, the companies within those economies are going to grow along with it. What happens in the short run, we have no idea. Because guess what? One of the tenets of our principle-driven investing is that in the short run, stocks are a voting machine. In the long run, they're a weighing machine. What's popular will go up in the short run. What's not popular will go down. But in the long run, the weighing machine drives the stock price. As earnings get better, revenue gets better, cash flow gets better, balance sheets get better, the stock will do well with it along the way. Your job is to dollar cost average all the way along. Never skip a beat there. Your job is to realize that successful investing is done here, not here. If you just dollar cost average in a low cost ETFs and don't sell at the wrong time because the world feels like it's falling apart, you're going to do very, very well. And for those of you who want to buy individual stocks at great prices, wait for these times. Still a dollar cost average to hit your goals in the ETFs, but wait for the right times to buy the right stocks. Most investors will pile into all the crazy investments or even the market at the wrong time. There's nothing wrong with dollar cost averaging into low cost ETFs. You're buying the US economy. But if you're the kind of person who's going to get scared when things look terrible and start selling, hoping you're going to miss out on some big fall in the market, you're going to end up losing in the long run. Guys, if you remember in 2022, we had a bear market and Meta kept falling. We made video after video about it and how we liked it below a certain number. And we were buying it. In fact, I got lucky enough to buy it at the very low on November 4th, 2022 at $88. Now that was dollar cost averaging into it. I happened to get it on the last day, but I bought all the way down. And everybody kept saying, Paul, you don't get it. Zuckerberg's an idiot. Metaverse is a joke. They're losing too much money. I thought to myself, wait a second. The revenue keeps going up. The profit keeps going up. If they all of a sudden realize Metaverse isn't working and stop, they're going to make $10 or $12 billion a year more. And this company is selling for literally single digit free cash flow multiple. Like that doesn't make sense. And guess what happened? You're sitting here and the stock just skyrocketed from there. I made the mistake of selling too soon because I saw the stock price shoot up to 200 very quickly and I sold at 195. Boy, do I regret that. Here I was getting it right all the way down and I sold too soon on the way up. But that's a lesson learned. And I want you to learn from that lesson too. If the fundamentals of a business are getting better and the stock is falling, you have found yourself a golden opportunity. Peter Lynch always says that. Nothing is better than finding a stock that's fallen, but the fundamentals are getting better. And the hard part is you have to be okay looking wrong. I was buying on the way down. Same with Alibaba. I was buying it on the way down. People look at prices saying that makes you right or wrong in the short run. It does not. In the long run, it does. When you know how to evaluate a business and see the disconnect between perception and reality, you can jump on great companies while they're out of favor. But remember, it doesn't take away from your goal of dollar cost averaging in low cost ETFs. Guys, I'm making this video on Monday, April 7th. This morning, the market opened, the NASDAQ was down 5.01%. At one point while we were recording this video, the NASDAQ was up 4% in less than 1 hour after being down 5%. That is a 9% swing in less than 1 hour. Are you going to react to that? I think it's an amazing, amazing thing to just watch, but it doesn't make me think the markets are any more rational than they were before. This is part of what we're talking about here. I have other examples. Alibaba, which I still don't think is at its full value. This company was left for dead. China's terrible. It's communist. Boom, boom, boom. The stock got as low as 60. Then it skyrocketed to 150. Southwest Airlines, currently experiencing temporary issues. I think they're temporary, but I think there's a lot of long-term potential. Microsoft, back 12, 13 years ago, I met with a tech CEO, and I made some joke about how obviously Microsoft was cheap enough to buy, and everybody would buy it if they could get it for free and $100 billion in the bank account. And he looked at me and said, no, Microsoft's dead. And I'm like, but their revenue and profit are going up. It doesn't matter. They're dead. It's like, wow. How many people would now say Microsoft is dead? Not because it's actually not dead, but because the stock price has absolutely skyrocketed. Back then, I was buying between $17 and $22 a share. Now, it got all the way up to 500, and now it's back to the 300s. But guess what? I sold it too soon again because I thought it was overvalued. I didn't let my winners run, and that's a huge mistake I've learned in this market. Guys, you don't need 50 winners. Just buy a few great stocks along with your low-cost ETFs, and it can really change the way your retirement looks. Even adding 1% extra per year can mean $100,000 more. Let me show you in that example on Retirement Calculator. Let me pull it up right here to show you guys 9.5% return. Let's make it 10.5%. If you recall, at 65, you were going to have 5.6 million. Look how different it is now. Instead of 5.6 million, $7.3 million on 1% difference. Now, what we do on this channel, it's something I do personally, is I sell covered calls on the stocks that I own. What that means is I have a stock. I sell somebody the opportunity to buy the stock from me at a future date at a future price. So as an example, and I use this white area right here. Let's say I have XYZ Corp and it's selling for $50 a share. I might sell somebody an option for 1 month from now for 50 cents to buy the stock from me at $55. So if the stock ends up below 55, I just keep the 50 cents and nothing happens. If it goes above 55, I have to sell it to them for $55. But but they still gave me 50 cents. Now, this is a little risky, but I do it on my portfolio of 25 to 30 companies. So I look at it as a way of generating income. And I've been doing this since June of 2020. I've had a few down months, but overall, I've added 3 to 5% returns per year. Now, I have the stomach to do it. I do it very systematically. That doesn't necessarily mean you're going to do that. But let me show you the difference in investing when you do that. If you're able to generate an extra 3%, go to 12.5% from the original 9.5, and you do it in a tax-effective and tax-efficient account. Instead of $5.5 million, look at this, guys. $12.6 million. This is not a guarantee. There's a lot of things that have to happen. But if you do it the right way and don't try to make 10, 12% of your money extra, you can do very, very well. A covered call is a great way to generate additional income from your stocks. And the best part is, then in retirement, you can start living off that income. My goal is not huge. I see covered call people trying to make 10, 12% extra a year. I'm trying to make an extra 2 to 4% per year. That's it. Last year, I hit that mark. Mo, my cohort in crime over here, he made 7%. It was a really good year for him on covered calls. You take the shares you already have and you sell someone the right to buy them from you later at a higher price. And the best part is you don't have to do it in your entire portfolio. You can do it on partials. And if you do this in a tax-efficient, tax-deferred account like an IRA or 401k, you're not even paying tax on that. And some 401ks allow it and others do not. 2 to 4% doesn't sound like much. But as I showed you here, in the long run, it's absolutely huge. If that 1% difference meant that much, look at that difference here of 3%. It's an absolute game changer. That's where $100,000 comes in, because at $100,000, that gives you a portfolio that could probably allow you to sell covered calls on a good chunk of it. Remember, not all retirement accounts allow this, and this is not free money. I've seen a lot of people blow up their accounts by selling covered calls. But if you do it right, and you're systematic, and you realize you're going to have downtimes, this edge could really add up over time and really move that needle. So guys, if that sounds interesting to you, and you want to learn more about covered calls and how it can change the way in which you retire, click the link below, input your email, and you'll get a step-by-step guide on covered calls. This will give you enough information to be able to understand more about covered calls and if it's the right process for you. Guys, life is all about balance. Yes, we want to make a lot of money, but you got to have balance in life. And that's why I like covered calls. For me, it allows me to do more, allow me to invest in other areas and not worry about pulling money from different areas to live. That's what works for me. But for you, it might be more about how can I double or potentially triple my money in investing in my retirement someday down the road. So guys, I really encourage you to go download that step-by-step guide for covered calls. Even if you're not ready with 100,000, it's important to understand them now. That way, when you do have the 100,000, you're ready to jump on it. And it's really well done during bear markets, because if markets are going down, you're selling option prices at higher dollar amounts. So you're less likely to lose those shares. So guys, I've also picked 7 stocks that I think will beat the market. They're my own personal Max 7. So if you're serious about finding value in this market, you have to watch this video. I just picked these 7 stocks, and no, they're not hype stocks that everyone else is chasing. These are companies with real fundamentals, strong balance sheets, and long-term upside that gets value investors excited. So go check it out and learn why they have massive upside and avoid the overpriced junk out there. So click on the next video linked on the screen. Thank you for your time.